Welcome to Volatility 411 for Equity Armor Investments. I'm Joe Tigay. Let's get right into it. Seeing the markets advance again today, we're reaching all-time highs in some of the indices as we're seeing some of the risk of the Fed tightening ease, in spite of the fact we're seeing inflation expectations continuing to go higher. We were told that they were temporary. We were told that they were transitory. Inflation expectations continue to beat expectations time after time, and it doesn't seem to matter. And on top of all that, we just talk about spending more and more money, and inflation seemingly is not going anywhere anytime soon. All of that said, one really important metric of inflation is wages. That's not going up. And that's good for the Fed, I guess, because we won't have runaway inflation. But isn't that bad for everybody else? Prices go up, but you're not making more money. That should be bad for the economy, one would think. We'll see how that plays out. The Fed is intent on allowing a little bit of inflation and getting employment back to where it was pre-pandemic levels. We'll see what happens. In the meantime, the markets are just loving it. We're cruising to all-time highs, and big cap tech is leading the way. In the VIX, we're at 1640 right now. An interesting thing I'm seeing with expiration next week, the 16 puts are active. They're 30 cents. You remember last week we dipped down to 14. So that's an interesting spot. People are looking at potential downside there. And of course, I love the SKEW. It's still really high. Just telling me that downside puts are more expensive than at the money vol. If I were interested in looking at getting long volatility, I'd be looking at the at the money strike, not looking at the downside puts, and maybe looking at getting short volatility. The downside puts are a more attractive spot for me. That's just what it says to me on the curve. That's not a recommendation. For Equity Armor Investments, I'm Joe Tigay.